When most people first think about investing, the picture in their mind looks almost magical. They imagine putting a little bit of money aside every month, watching it compound, and one day waking up financially free. They see their future self traveling the world, buying the dream house, or retiring early without stress. It sounds wonderful, doesn't it? But here's the reality check. For the majority of beginners, the path doesn't look like that dream. Instead of growing steadily, their portfolio goes up and down, they get frustrated, and very often, they lose money. And at that point, many beginners start asking themselves, now, here's the truth. Most of the time, it's not the stocks they picked that failed them. It's not even that the market was unfair. It's the mistakes they made along the way, mistakes almost every beginner makes. And that's exactly what this video is about. I'll take you through the 7 most common mistakes new investors fall into, explain why they are so dangerous, and most importantly, how you can avoid them. If you avoid even half of these traps, your chances of building real wealth will skyrocket. Welcome to Martic Finance, where we break down investing into simple, practical lessons. And before we begin, a quick reminder, this is for educational purposes only, it's not financial advice. Alright, let's dive in. If you're new to investing. The first strategy that probably comes to mind is this: buy low, sell high. Simple math, right? If you just buy when the stock is cheap and sell when it's expensive, you'll make money. Here's the catch: if it were really that easy, everyone would already be rich. The problem is, nobody, not even the smartest hedge fund managers, can consistently predict the exact highs and lows of the market. Let's say you see the market dip. You think, okay, I'll wait a little more until it drops further, then I'll buy. But suddenly, instead of falling more, the market bounces back up. Now you're left watching prices climb while you're sitting on the sidelines. On the flip side, maybe you buy because you think a rally is starting, only to see prices crash the very next week. That roller coaster of emotions leads to frustration, overtrading, and usually losses. History is crystal clear on this. If you had invested $10,000 in the S&P 500 back in 1995 and simply left it alone, by today you have turned that into well over $200,000. But here's the scary part: if you missed just the 10 best days during that 25-year period, your return would be cut almost in half. 10 days. That's how costly market timing can be. Investing isn't about perfectly timing the market, it's about time in the market. The longer you stay invested, the more you let compounding do its job. If you're constantly jumping in and out, you rob yourself of those big upswings that make all the difference. So instead of asking, is now the best time to buy? Shift your mindset to, how long can I stay invested? That's the difference between gambling and investing. Let's be honest, this is probably the toughest mistake of all. Because it's not about numbers, it's about emotions. When you see your portfolio dropping day after day, your brain screams, get out before it's too late. It feels like the smart, safe decision. But history shows the opposite. Think back to early 2020. The world was shutting down. Headlines were filled with words like pandemic, recession, and collapse. In just a few weeks, the S&P 500 lost almost 30% of its value. For many beginners, the fear was overwhelming. They sold everything to protect what was left. But what happened next? Within months, the market fully recovered. And over the following 18 months, it doubled. Those who panicked and sold locked in permanent losses. Those who stayed calm and held on saw their portfolios grow to record highs. A drop on paper is not a real loss until you sell. Markets go up and down all the time. It's not a sign that you should run. It's simply the price of long-term growth. Think about it. The stock market has survived wars, recessions, oil shocks, political crises, even a global pandemic. And every single time, it has recovered. The best way to avoid panic selling is to build an emergency fund. If you have 3 to 6 months of living expenses saved up, you won't be forced to sell your investments during a crash just to pay your bills when you know you don't need that money tomorrow. it becomes much easier to stay patient. Asterisk asterisk, this one is almost irresistible. You hear about a stock that's skyrocketing, everyone on social media seems to be making money. Your friends are talking about it, news outlets are hyping it, and you don't want to miss out. So you jump in. And then, almost like clockwork, the hype fades and the stock crashes. Asterisk asterisk, Dogecoin in 2021. Sure, a handful of people who bought early became millionaires, but most who bought near the top lost big chunks of their savings. GameStop and AMC, same story. Early movers cashed out, but the late crowd held the bag. This isn't new. Back in the late 1990s, during the dot-com bubble, companies would literally add double quotes .com to their name, and their stock price would soar sometimes by 70% in a single day. Many of those companies had no real business model, and within a couple of years, most collapsed to zero. Asterisk asterisk, by the time everyone is talking about a stock, it's usually too late. Instead of chasing hype, focus on building a solid, diversified portfolio. That's what creates wealth over decades. Not chasing the latest fad. Asterisk asterisk, putting all your money into one company, one sector, or one type of asset might feel exciting, especially if that company is popular, like Tesla or Apple, but the risk is massive. Asterisk asterisk, in 2001, Enron was one of the biggest companies in America. Employees believed in it so much, they invested their entire retirement savings into Enron stock. But when the company collapsed in scandal, those employees didn't just lose part of their portfolio, they lost almost everything. Asterisk asterisk, if one stock fails, you're protected by the others. This is why index funds and ETFs are so powerful. They spread your money across hundreds, even thousands, of companies. It's like this. Don't put all your eggs in one basket. Put them in 10 baskets, so if one falls, you don't lose breakfast. Asterisk asterisk, fees might look small, but over decades, they eat away at your returns like termites in a wooden house. Imagine to investors, investor A puts $100,000 in a fund charging 2% annually. Investor B puts the same $100,000 in a fund charging 0.05% after 30 years. Investor B could have hundreds of thousands more just from avoiding high fees. That's why John Bogle, the founder of Vanguard, fought so hard to create low-cost index funds. He knew the biggest enemy of investors isn't the market, it's unnecessary costs. Asterisk asterisk, throwing money into random stocks or crypto without knowing why is a recipe for stress. Imagine one beginner invests a little in Tesla, some Apple, a bit of Bitcoin, and some gold. Every day, prices move differently. Tesla falls, Bitcoin rises, Apple is flat. The beginner doesn't know what success even looks like. Contrast that with an investor who has a clear plan, goal, retire in 30 years. Strategy, 80% in index funds, 20% in bonds. Rule, adjust gradually as retirement gets closer. That investor doesn't panic over daily swings because they're focused on the long-term target, not short-term noise. Without a plan, you'll always feel lost. With a plan, you'll feel in control. Asterisk asterisk, this is perhaps the biggest mindset trap. Many beginners think investing is a fast track to wealth. They want overnight success, but the truth is, investing is a long game. The rewards go to those who are patient. Asterisk asterisk, if you had invested $1,000 in Amazon in the year 2000, by 2000 your investment would have dropped 90%. Most people would have sold in despair, but those who stayed invested, that same $1,000 would be worth over $60,000 today. Asterisk asterisk, Warren Buffett said it best. The stock market is a device for transferring money from the impatient to the patient. In other words, the people chasing quick money usually lose it to the ones who are willing to wait. Asterisk asterisk, so let's recap the 7 deadly mistakes beginners make. Trying to time the market, panic selling during drops, chasing hot stocks or trends, not diversifying, ignoring fees, investing without a plan, expecting to get rich quickly. If you can avoid these, you'll already be far ahead of most beginners. Remember, investing is not about luck or gambling, it's about patience, discipline, and long-term thinking. So the next time you feel fear, greed, or FOMO creeping in, remind yourself, the market rewards those who stay calm and stay the course. If you found this video helpful, please consider subscribing and liking it helps us grow this community and bring more people on the path to financial freedom. Thanks for watching, and I'll see you in the next one.